Welcome to Crack Your Interview. In this session, we are covering Module 8, Final Accounts for Insurance Companies. We will learn how to prepare final accounts as per the NAIC prescribed format, including the revenue account, the profit and loss account, and the balance sheet. We will also prepare supporting schedules and understand disclosures through examples and case studies. By the end of this session, you will be able to: first, understand the importance of final accounts for insurance companies. Second, prepare the revenue account, profit and loss account, and balance sheet in NAIC format. Third, draft schedules for premiums, claims, commissions, and reserves. Finally, interpret notes to accounts, study a case example, and answer interview-style questions. Insurance companies collect large amounts of premiums from policyholders. These funds belong to the public, and regulators want to ensure that insurers remain solvent and transparent. For example, suppose an insurer collects 100 crore rupees in premium and has claims of 95 crores. Regulators still want to see if the company has adequate reserves to meet future claims. This makes final accounts critical for trust, compliance, and financial strength. In the United States, the National Association of Insurance Commissioners, or NAIC, prescribes a uniform format for insurance company reporting. In India, the Insurance Regulatory and Development Authority of India, or IRDAI, requires statutory formats under the Insurance Act. For instance, both regulators require reinsurance transactions to be disclosed separately, because reinsurance changes the actual risk retained by the company. The structure of final accounts includes three parts. First, the revenue account, which shows results from underwriting operations. Second, the profit and loss account, which includes investment income and overall profit. Third, the balance sheet, which presents assets, liabilities, and reserves. These are supported by detailed schedules and notes to accounts. The revenue account captures core insurance activity. For example, net premiums earned are 500 crore. Claims incurred are 400 crore. Commission paid is 30 crore. Operating expenses are 40 crore. That leaves an underwriting surplus of 30 crore. This shows whether insurance business itself is profitable. Here is a step-by-step illustration. Suppose premiums are 1,000 crore. Reinsurance ceded is 200 crore. That means net premium is 800 crore. If claims are 650 crore, and expenses are 100 crore, then the underwriting result is a 50 crore surplus. The profit and loss account goes beyond underwriting. Suppose the underwriting surplus is 50 crore. Add investment income of 70 crore, and we get 120 crore. Now deduct 20 crore of management expenses. The final net profit is 100 crore. The balance sheet shows the financial position. Assets include investments, loans, fixed assets, and cash. Liabilities include capital, reserves, outstanding claims, and the unexpired risk reserve. For example, if an insurer collects premiums of 600 crore in December, but the policy covers the next 12 months, then about 450 crore must be carried forward as unexpired risk reserve. This schedule details premium income. For example, direct business is 500 crore. Reinsurance accepted is 100 crore. Reinsurance ceded is 150 crore. So net premium is 450 crore. This shows exactly how much risk the insurer has retained. Claims are the largest cost for insurers. For example, claims paid are 350 crore. Add outstanding claims at year-end of 70 crore. Less outstanding at beginning of 50 crore. That gives net claims incurred of 370 crore. Agents and brokers earn commissions for bringing business. For example, commission paid to agents is 25 crore. Commission to brokers is 10 crore. Commission recovered from reinsurers is 5 crore. So the net commission is 30 crore. Reserves are provisions for future obligations. For example, unexpired risk reserve is 200 crore. Outstanding claims reserve is 100 crore. Catastrophe reserve is 50 crore. Together, reserves protect policyholders in case of unexpected losses. Notes explain accounting policies and provide extra transparency. For example, investments are valued at cost or market, whichever is lower. Claims incurred but not reported, also called IBNR, are estimated by actuaries. Contingent liabilities are separately disclosed. And if an insurer invests in bonds of its parent company, this must be reported as a related party transaction. Let's walk through a case study. Premium is 1,000 crore. Reinsurance ceded is 200 crore. Net premium is 800 crore. Claims are 600 crore. Commission is 50 crore. Expenses are 80 crore. That leaves an underwriting surplus of 70 crore. Now add investment income of 100 crore. Final net profit before tax is 170 crore. Let us practice some interview-style questions. Question 1. Why is unexpired risk reserve required? Answer: because premiums collected in advance must be matched with the future risk period. Question 2. How is reinsurance treated? Answer: premiums ceded reduce income. Claims recovered reduce expense. Question 3. Why is solvency margin important? Answer: to ensure the insurer can pay claims even in adverse years. Question 4. How do we treat IBNR claims? Answer: they are estimated by actuaries and disclosed in notes to accounts. To summarize, final accounts ensure solvency and transparency. The revenue account shows underwriting performance. The profit and loss account includes investment income. The balance sheet reflects reserves and liabilities. Schedules and disclosures provide detailed insights. Thank you for joining this session on final accounts for insurance companies. If you found this helpful, please like, share, and subscribe to crack your interview. Best wishes for your exams and interviews.